The RBI has opened a one-time restructuring window. Borrowers, including individuals and MSMEs, permitted one-time restructuring till September 30th of this year. This facility, he says, is going to be available for those having an aggregate exposure of about 25 crore rupees. They've also, announced a targeted loan-term repo operation for small finance banks of up to about 10,000 crore rupees. The funds can be used, he says, for lending of 10 lakh rupees per borrower. SFBs have been permitted to on-lend to smaller microfinance institutions of asset size of about almost 500 odd crore rupees. Quickly, I'm going to take away what the markets are reading into this, because we are holding on. The resilience, the show of resilience pretty much continues for equity markets. We're holding on to an 80-odd point gain for the Nifty futures as we speak right now, and the breadth of the market as well is holding strong. I just want to quickly check in on what banks are up to before I take it across to Mythili Bhusnurmath as well and analyze what the takeaways from the governor were, because you are seeing small finance banks actually hold out in trade, but that was a trend which you saw pre the RBI governor's address as well. Very quickly on to the bond yields as well and how the money markets are reacting, because pre the speech you had the yield actually fall to its lowest level since about April 9th, as there was heightened anticipation from the governor's address, and the yield will just come up for you on your screens very quickly, as well as the rupee. But Mythili, quite a few announcements, an unscheduled address. What's been your takeaway from what the governor has said today?
Well, first let me focus on the good parts of it. The good part of it is that the RBI has finally realized that the suffering is most at the bottom of the pyramid. So they have extended the kind of restructuring, etc., to small loans, individuals, MSMEs, small businesses of just 25 crores. And this is available to the 30th of September, with 90 days for implementation. They've also extended a helping hand to small finance banks and in turn to microfinance units. So that, I think, is a good thing. The not so good, and of course, there is one very good thing also that the governor announced, is the term lending liquidity facility of a pretty generous amount of 50,000 crores for healthcare infrastructure at the repo rate until 31st March 2022. Now, while this sounds a very generous number, I'm not sure how much of it will actually happen, given that the need for this health infrastructure is right now is so immediate and critical. But certainly it is a very wise move on the Reserve Bank of India to understand that this is what the country lacks most sorely and focus attention on that. The focus is on health infrastructure, rightly so, and at the bottom of the pyramid. But they've also eased things like KYC requirements for individuals. The banks periodically insist on, updating of KYC, which creates a great deal of problems at such points of time. So for banks, again, there is some benefits, small benefits in terms of they can use floating provisions for covering NPAs. And states, again, get a good look in by saying that the overdue facilities, overdraft facilities for states, the period has been extended. They're not so, I would not say good, but slightly, I would say, short-sighted or blinkered view is that in terms of the macro economy, the statement that aggregate demand is going to be only moderately affected, that seems a little overly optimistic at the moment, given that we're seeing that there's just no way that the economy can escape the wrath of the second wave. So that seems to be a slightly, excessively optimistic view. He also said that we see no reason to have any broad deviation from the MPC statement of April. Now, an MPC statement in April has stuck to the earlier GDP estimate for the year of 10.5. Now, that is not going to have contraction. That is not going to happen at all. It is certainly not going to happen. So I think we really need to kind of relook at those numbers. Perhaps the governor was hesitant to speak anything definitely, given the fact that we are going to talk in terms of, that this is the MPC's mandate. But the MPC's mandate is only as far as interest rates are concerned. I think he should have been a little bit more forthcoming on his worries, which he should be having as far as GDP growth is concerned. There is just no way we will achieve that 10.5%, and I think the governor should perhaps have given some recognition to it. Of course, we'll get the numbers at the end of May. We'll get the numbers for the previous fiscal, the fiscal that has just gone past. But clearly 2022 is not going to be that year of recovery that we had hoped for.
Yeah, seems to be the case, and the governor was pretty categorical in saying that even at this time, in the run-up to the MPC meeting, when our teams are analyzing the various incoming data, we don't expect any broad deviation from projections made in our April MPC policy, but very categorically said that you'll have to wait for MPC statement due in June first week to really analyze all of that. We also have Mr. Rajnish Kumar, joining in to talk about what he's made of what the RBI governor said. And Mr. Kumar, let's focus first on the positives. Much the need of the hour and quite a relief really coming in to the bottom of the pyramid in terms of relaxations made for the SME and the MSME sector.
Right. I think this is the first of series of the measures. Even from the governor's speech, you could make out that as they have more data and as the situation unfolds, RBI would not hesitate to take more measures. So this is the first set of announcements. And the immediate priority which is coming out very clearly is that improved flow of credit to the health sector. So one major announcement is around at least 50,000 crore. It is expected that banks would lend to the healthcare sector and it will be treated as priority sector and added incentive of getting higher rate on the money parked with the Reserve Bank of India. Second set is, of course, extension of timeline for restructuring. And to begin with, of course, the focus is for the small borrowers having credit limits up to 25 crore. And the liquidity support where 35,000 crore under the government security buying program, which will release another 35,000 crore liquidity in the system. So there are a couple of measures. And as I said, that this is the first set of measures. And as the situation unfolds and RBI will have more data, then some more measures may be announced. And this we saw last year also, that there were several announcements over a period of time. And very well calibrated response from RBI came. And there's no doubt that this year also, the response will come from RBI depending upon the situation.
From SBI as well. And, to talk about what he made of what the RBI governor's unscheduled address actually entailed. Mr. Kumar, morning. Thank you so much for taking the time out and speaking with us today. Quite a detailed lineup of what the report card from RBI's end is looking like and what are the measures that the RBI is going to take to try and tackle the second wave of the virus. And, the point that Mr. Rajnish Kumar as well, your co-panelist, was just making, the fact that there is a 40 bips reverse repo incentive coming in for banks for COVID loans, and banks can now classify lending to health infrastructure under priority sector lending. The point, of course, is, while there's no taking away from the fact that this is much the need of the hour and a very, a step in the right direction in that sense. But one really has to take a step back and analyze as to how much of the portfolio of banks currently is lending to healthcare infrastructure, and more importantly, how much of this is actually going to trickle down.
Yeah, so let me begin by saying that this is a signaling kind of announcement, which is very detailed, yes. And as Mr. Mehta was mentioning shortly, that this is something which will probably have a series of steps like this. So it was important for the
Dr. Kamakodi, what is your initial reaction to the governor's address, and how much of it do you think will really ease the pain of the borrowers on the ground, particularly the small borrowers?
Yeah, definitely. Like say even though let's say people were expecting some sort of moratorium or sort of like what happened in the first round, I think whatever that has been given out in terms of giving the restructuring, liquidity and refinancing facility, and also which can probably support to those who used the restructuring before 31st March also. I think it is sufficient at this point of time, and the signal is very clear that if at all things deteriorate from here, if at all anything is required, further things will come. As of now, things look it is very much on the right direction and also at the required amount. It is increasing the confidence, particularly during the time of when the pandemic is increasing multifold.
Mr. Tewari, at a time when banks are just struggling to keep basic business going and keep ensuring that their branches are open because so many of their staff are frontline workers, and have not received adequate support from the government in view of their services they have rendered, do you think banks will really be able to finance healthcare infrastructure at this juncture, take on something like this at a time? Of course, it's a very good measure, but it's more an intermediate measure. Do you expect this really to have a large-time COVID loan book, the banks to have a large, big-time COVID loan book, Mr. Tewari? I think we have lost Mr. Tewari. So let me just ask the same question to Rajnish Kumar. Mr. Kumar, my question to you was that at a time when banks are struggling to keep even basic operations at the branch level going, because so many of their staff have fallen prey to COVID, and many in fact have lost their lives, they've not really been recognized by government as frontline workers in terms, etc. When they have all these worries on their mind, do you really see them extending fresh loans for healthcare infrastructure, however worthy and however desirable it might be, at such a juncture? So this talk of, being able to spark your surplus with RBI at 40 basis points above your reverse repo rate to the extent of a loan book, do you expect the loan book to be sizable, Mr. Kumar, at least in the immediate term?
No, what you have mentioned is very correct, that this time whatever numbers are coming, where the bank employees have been very badly impacted and many young lives have been lost. So this is a very unfortunate situation, but still, as they say that there is still rendering the service, branches are still open, banking is an essential service. So whether they get recognition or not, but they continue to do yeoman service. And I'm happy that you raised this point. And they must be appreciated. But irrespective of the fact, as I said, that they are on their duty and the business has not stopped, whether it is deposit taking or providing remittance facilities or the lending business. So this is an added incentive. The bank's exposure to healthcare sector was not too much. Like mostly it would be to the corporate hospitals, or maybe some banks have a scheme for financing of doctors under individual category for buying essential equipment. So this is one more window, one more opportunity. And nowadays, a lot of lending happens where technology is used. So it will take a little bit of time to put everything going. But in how much time they will be able to utilize this 50,000 crore or deploy? It's not a huge sum of money of all the banking system taken together. But the due process of appraisal, due diligence, that will have to be done. But some of the things can be done very quickly. It takes more time for giving term loans for creating any infrastructure, like if you want to build a new hospital. But this is not the time where we are looking at building just the new hospital. What is being needed is, say, import of equipment. So immediately LC facilities. Establishing LC facility or the working capital lines is much easier and can be done. So I'm sure that banking system, they have been doing a full service, and maybe they should be able to continue. And depending upon who all needs support and approaches the bank, they should be able to support, particularly, I think, the requirement around any procurement of immediate equipment. That is an easier part. Building a new hospital or buying a very costly equipment, then that requires more due diligence and more time to give that kind of loans.
You're absolutely right on that, Mr. Kumar. The best way, the quickest way would be to extend new working capital requirements, ensure easier opening of LC so that import of equipment can be expedited. That certainly would be the way, along with some recognition by the government of the contribution, particularly of public sector bankers, in ensuring that banking services are not affected at the risk of their lives. And let me now move to Mr. Ashutosh Khajuria and ask Mr. Khajuria, as a bank like yours, you have much greater links with small finance banks and microfinance institutions. Will this go a long way to assuage their problems, Mr. Khajuria?
Yeah, I think to some extent, I think there would be some incentive to lend, because when you have such, sort of support coming from central bank in the form of liquidity and all, there is ample liquidity in the system, but it is slightly skewed. some have too much of surplus liquidity. Some have already utilized their liquidity for lending and investments and all that. I mean, either directly in the form of loans or the credit substitutes. So I think such an arrangement, and the biggest support is that if you are lending to this pharmaceutical sector and that COVID-related activity, and still you garner some liquidity, you can at least place it. The Reserve Bank of India at just 25 basis, the old spread between reverse repo and repo rate, which is 25 basis points. So at 375, you can place it. So the negative carry would be negligible. It's not that you raise at a particular rate, say average cost of deposit or even from RBI, and then place back with RBI at 325 or 335 or so. So I think reducing the spread for this specific activity for directed lending should help, I think incentivize the lenders to look at such opportunities. And they can be ready with their gunpowder, the arsenal, and then look for the right cases to fund, because it doesn't happen simultaneously. There will always be a mismatch wherein you may raise resources a little earlier and deploy maybe with a lag. But during that lag period or so, there would not be too much of a negative carry. That's a very positive point of it.
Comfort from the fact that the GSAP program has gone well, whereas actually the feedback is that it has not gone so well because not all maturities were taken up, and RBI has had to cancel the auction of GSECs in the recent past. Is the RBI barking up the wrong tree when it persistently tries to push the yield curve down against market forces, when it is not that liquidity is a problem, it is the huge supply of government paper and apprehension that this low rate that the RBI is forcing on markets is artificial, Mr. Khajuria?
I would say, how can you optimally utilize your, resources is something, which everybody looks at. 10-year as a benchmark is something which is used for pricing of corporate, pricing of SDLs. SDLs are as large, that program is as large as central government securities. And everybody looks at what type of spread over, CGSEC you have there, And most of the, issuances on the SDL side happen in the 10-year maturity. So when you have huge amount being, raised, then I think it's necessary that, because the issuance is happening for next 10, 15, 20, 25 years or so. So at today's cost, if they allow the yield to just shoot up, and then for next, because these are fixed income securities, fixed rate, and so therefore for next 10, 15, 20 years, the cost will be very high. I think it's all the more necessary to just look at, I think the macro, commensurate to macro numbers or so, the yield curve is there. So I think probably there is some, speculation-related kinks coming in yield curve. These can be smoothened by intervention of the central bank, and that they have been doing on the forex side as well to contain volatility. And here also to have a reasonable return vis-a-vis the CPI or so. And for a longer term ahead, I think the steps taken by central bank are paying dividends. And this is clearly coming up in the 10-year benchmark yield.
Let me just toss the same question over to Neeraj Gambhir and ask him, Neeraj, would you agree with Ashutosh's assessment that the RBI is wary of getting locked into a high rate of interest and so desirous of pursuing a lower rate of interest? Now, one can entirely understand the RBI's desire because it is the merchant banker for the government. But how long can you fight against market forces? Remember what happened with a single man, George Soros, could bring the Bank of England down to his knees. So is the RBI just barking up the wrong tree in persistently trying to lower yields when the market will not yield? Mr. Gambhir, that was meant for me. Neeraj Gambhir.
Mr. Gambhir, can you hear me, sir?
Do we have Neeraj Gambhir with us?
Ashwini Kumar Tewari.
Ashwini, I think we lost Neeraj for a moment, but I guess you heard that question. Or would you want me to repeat it? My question was really about the RBI's determination to pull down yields against the dictates of the market. Can a central bank, however powerful, be able to fight against market forces? Ashwini?
So, yeah, so Mythili, actually, this is the desirable objective, as Mr. Khajuria was explaining earlier, that these are long-term papers and there is a large borrowing program, and also the fact that this is a signaling rate for state loans and many other corporate loans as well. So therefore, considering that it is a desirable objective, RBI is right in trying to do this. Now, I take your point on the challenges before RBI in terms of the large borrowing program, in terms of market participants wanting a higher yield. But in terms of not being able to do this, I would only point out to the fact that there is a reason why RBI has capped the input from the foreign investors, which is significant, but it is not indefinite. So they can't really pull down the entire market. And they are not fully invested also at the moment. So I think the RBI is right in trying to do this, which is a desirable objective not only for RBI, but also for the government and also for the sector at large. And I don't see RBI failing or RBI not being able to do this. It has been able to do this so far. The last year's program has been through, and the current year's program also is beginning, and maybe it will go up a little depending on the situation. So I think they will be able to pull this off.
Well, one is not disputing the desirability at all, because the RBI obviously has to try and get as low a cost of borrowing for the government, since it is this risk-free basis of lending. The question, and this is where I come to you, Mr. Rajnish Kumar, is to ask you whether it is, worth the price that we are paying. Because the only way the RBI can push yields down is by increasing liquidity at a time when we've already seen inflationary pressures are very much on the uptick. Not just overall inflation, but also core inflation at a time when inflation pressures are rising globally. Mr. Rajnish Kumar. Okay, I think Ashutosh, I will have to come back to you, because you were the one who put up a very fierce defense of the Reserve Bank of India's action. And I'm with you in saying that this is, yes, a desirable role for the Reserve Bank of India to play, and it does impact the cost of borrowing for the entire economy. My question was not whether it is desirable. The question is it feasible? Does RBI have the ability, number one? Number two, what is the cost of RBI pursuing this path? Because the only way it can push yield down is by increasing liquidity at a time when we've seen inflationary pressures are very much on the uptick, not only headline inflation, but also core inflation. So are we paying a price that is commensurate with a goal?
I think the word commensurate is very, very important. You have to weigh the pros and cons, whether the cost is more or the outcomes are more, beneficial for the economy. And a team of, or rather an army of, people in RBI and, the support agencies like, who provide their inputs, which RBI always gets enriched by. So I think I would again say this thing that you have to look at macro. You have almost all-time high forex reserves. You were commenting about George Soros and all. Please remember what type of forex reserves Malaysia had at that time. If you are talking of Mahathir Mohamad's this thing fight against, so-called the currency raiders and all. So I think all these things are very important to analyze what were the situations there and how these speculators could fare there in a given in the given circumstances. Please remember, all those economies were more or less convertible on the capital account. So we don't have capital account convertibility. That's one point which goes in our favor in such situations where we have such challenges. Your forex reserves are all-time high at about 588 billion, which is what, as on 30th April, Governor, shares. Our CPI is, I think sub 6, and I think the core inflation also is closer to 5 or 5 plus and all that. Not out of the band that they had, 2 to 6 and all. And then it remains, I think, whether this type of borrowing is going to be there for, every year or so, or is it a temporary phenomenon, I think, which is directly linked to COVID-related crisis. So you had that in FY21, you may have that in FY22. Going forward, I think the roadmap that was given in the budget, it looks like, the borrowing quantum, absolute term also would go down, leave apart in percentage terms vis-a-vis GDP. Hopefully, GDP grows, the percentage would fall sharper. If in nominal terms, absolute terms, the amount of borrowing goes down. So I think my point is looking into all these things. And then, of course, you always have something like where you can measure and take, fresh steps or so. the announcement of 100,000 crores, which they said, through GSAP, they would be doing it for 1 quarter. And let's see, what the outcome is. I think the first installment, first tranche, resulted in keeping the yields in check. Now, second one has been announced, 35,000 crores, and that's on 20th May. And let's watch, and I think calibration, periodic calibration, and taking stock is the mantra. And whatever is needed can be done. Otherwise, you can't make, the country hostage for future also, for our successors also, at such high cost debt, in case you allow yields to go to 8%, 8.5%, 9% or so, we have seen in the past. 3-4 years back also, we had that type of scenario. So I think letting it go to their 8.5%, 9% type of 10-year benchmark yield, I think it's better to contain it somewhere, which should be commensurate to what our macro numbers are. So if your inflation is in double digit, 10, 11, 12%, yeah. So a GSEC yield also can go there, and then there is a logic for that. And as about the monsoon and, projection about, expectation about, primary article production and, food grains and various other things, I think it should be, RBI should be able to manage, the right level of yield curve, right levels of.
Well, you're clearly an optimist, Ashutosh, and I do hope you're right. That's in fact what all of us would hope for. But sometimes it becomes a little difficult to see things optimistically when all around you see such mayhem. But let me now just move to Mr. Kamakodi and ask him, Mr. Kamakodi, the relaxations that are made on KYC. Now, KYC has become a big bugbear for ordinary customers. Do these measures go far enough to ease the periodic pressure and the pain that customers face at a time like this, when every year or 2 years banks want you to update your KYC? Even in the case of old customers, is this something that we really need to pursue much more vigorously, Mr. Kamakodi?
Yeah, see, now the video KYC, after it was, given regulatory assent last year, to greater extent now people are able to ensure that they are taking, they are able to make their KYC checked from a remote location. Only thing is that they want to ensure that it is happening within the country. And basically, I think the incremental ease of KYC that is being announced and all, finally it will, things will finally come to a shape only when you have a common database of Aadhaar, birth, death registration and all, the regulated entities having a link to that and all. Suppose, for example, nobody is misusing that or using for any anti-money laundering or anything like that. So incrementally, things are happening on the right direction, and probably, you may be having some reservation about the pace at which it is happening, but directionally, we are able to see things are getting eased up, and even the problems to the customers to go, updating the KYC and all are becoming easier now, and perhaps the COVID has given a lot of paradigm shift to the way the banking is done. For example, you asked earlier, you are not able to do a lot of transactions, and banks are also, whether to open the branches and closing itself is getting difficult and all. Now, after a lot of, movement to the alternate channels and digital channels and all, even at the remotest of the rural branches and all, by and large, may not be 100%, even at least more than 95% people are able to get to the banking services without any issue. So we are seeing positive things happening, and it should be getting better and better from where we are.
Right. We are also joined by Mr. Mahabaleshwara of Karnataka Bank. Mr. Mahabaleshwara, would you agree that the moves as far as KYC are concerned are overdue but very welcome? And the second question to you really is, as in terms of small finance banks and microfinance institutions, will this ease the pain that they are feeling, the special liquidity facility to them?
Yeah, 100%. See, in fact, as far as KYC updation is concerned, no doubt it is an ongoing and continuous process. But considering the prevalent special situation, the governor has paid emphasis on digital channels for KYC updation, and he has also given certain relaxation that would help all the banks to ensure the compliance without much inconvenience to their system as well as to the customers. And definitely the second one is this is a time to take care of the small borrowers. And that is what has been done through the Small Finance Bank. Special 3 years long-term repo operation, LTRO, of 10,000 rupees is also given. And of course, as far as the scheduled commercial banks are concerned, so special emphasis is already given for the individuals, small business and MSMEs who are having an aggregate bank loan of up to 25 crores. So if they had not availed the earlier restructuring 1.0, then they are now eligible for restructuring under the 2.0. Of course, this is to be invoked by September 21. So if they had already availed the earlier restructuring, then the period can also be extended by another 2 years. And of course, there is a provision for reviewing the working capital cycle as well as the margin. So by and large, definitely these measures would help the customers to tide over the situation. I consider it as a proactive and forward-looking measure, and that is what the governor has announced today. And definitely extraordinary situations, they demand extraordinary measures. Hence, today's announcement is a welcome step in that direction.
Ashwini, I know you have to go, but let me just ask you one last question before I let you go. That while today's announcements are focused on the bottom of the pyramid, the small borrowers, MSME, small finance banks, etc., are you surprised or a little puzzled that the corporate sector, the large corporates, have been completely left out? Is there RBI's view that enough has been done for them? Do you think we need to do more for them, Ashwini?
Yeah, so my sense is the direct impact is on the individuals, the small businesses and the MSMEs, which have less liquidity, less ability to actually take up any kind of stress. And they had already had one round of significant stress last year. So therefore, to support them and give them immediate relief, I think is the right approach. As far as large corporates are concerned, they already have done well. If you look at the corporate results, except for the directly impacted and contact sectors, the rest of the sectors have been showing good results. So, and as RBI Governor has said, this is the first series of steps. If there is a need for the large corporates on particular sectors to be also supported, I'm sure they would come out with additional steps. And as you pointed out earlier, the liquidity in the system continues to be high. The interest rates continue to be much lower. In fact, the lowest in the cycle, if I may. So therefore, the top corporates don't have a problem at the moment. As and when they start investing and as and when the economy goes up, I think whatever support is needed will be given by banks and if required, directed by RBI.
Hope you're right on that. Thank you so much, Ashwini, Mr. Kamakodi, Mr. Mahabaleshwara, Ashutosh also for joining us in the discussion and throwing light on the governor's announcements just now. And with that, it's back to the studio. Time for us to slip into a very short break.